These are the principles I now follow in order to be a profitable investor. And these are the principles that I wish someone had told me in the past, but really explained them to me and what they meant. And that way I would have invested with confidence. I would have invested with peace of mind. I would not have logged on to Yahoo Finance to check stock prices every single day. I would not have scoured the internet for news that confirmed my beliefs. I would not have even looked at anything on Reddit, thank God. But I did all of that, and I lost money as a result. And so the principles that I'm about to tell you are the principles that I am following today that gives me a peace of mind knowing that my money is well taken care of. And so here we go. I've picked these up over the years. Number one, invest in only what you understand. Now, before you click away, you probably heard this before, but how do you actually discern between whether or not you understood what you've invested in? That's a question I thought about for a long time, because everyone says to invest in what you understand, but no one tells you what's the benchmark or criteria for understanding an investment. So here's mine. You have to understand, I think, that there will continue to be demand for what you are investing in. And so you choose to invest in a currency, then the currency needs to continue to have transactional demand. That's the fundamental thing that drives the value of currencies. People want to make transactions in that currency. But we're going to focus this discussion on individual stocks and common stocks. And so most people are still figuring out whether or not they understand the stock that they're investing in. And so you understand an investment opportunity when you know how it can make you money, because the fact that an investment opportunity can make you money is what drives demand. For example, before buying a stock, you should understand that capital gains and dividends will be what makes you money in that stock. And so what capital gains are an increase in the value of the company itself. And that increase in value is based on the assumption that the company will continue to grow or become profitable or become more profitable. Dividends imply that the company will continue to be profitable because a company only pays dividends from its profits. And so if a company is borrowing money to pay dividends, that's really bad news. And so you also have to understand that any company that pays any amount of dividends, or if it does decide to increase significantly the amount of dividends that it pays, also believes that its growth is limited to an extent. Otherwise, they would have reinvested that money. Why would they pay you the dividend? So either way, you have to figure out how the company makes money and build an argument for whether it will continue to make more money into the future. Not only this, you have to ask yourself whether or not the company will make an amount of money so significant that it justifies a future increase in share price that goes above inflation. So for common stocks, you can do that with a discounted cash flow analysis, which I'm not going to go into in this video for the sake of brevity. It's hard to explain over video how to do a discounted cash flow analysis unless I share my screen. But you can begin to see the amount of work required before you should make an investment in a common stock. Yet most people do it because they feel good about it, or they think it will go up, and they think it's a spiritual sixth sense game, when in reality, it really should be a rational game of understanding the underlying fundamentals of a specific business and industry in the long run. And in the short run, it's more about a game of understanding investor behavior. Number two, so you have a conclusion, right? Let's say you've made a statement. You want to invest in a certain company. Well, you certainly have certain assumptions that you believe in when you make a statement like that. And so you need to test those assumptions about your conclusion. And so, for example, I personally hold S&P 500 ETFs. I hold VOO. I also hold XLG, which invests in the top 50 companies on the S&P 500. And so my theses are different for these two investments. They share similar assumptions, but the ultimate thesis is a little bit different. Now, with investing in these two ETFs, I don't need to go through the process of understanding each individual business, because business-specific risk gets diversified away when you own about 18 to 20 uncorrelated assets. Keyword uncorrelated. So the first thing I have to do is sit down and I have to figure out, are these assets uncorrelated? And it turns out to a large extent not, right? To a large extent, the assets in the stock market, like stocks, are largely correlated with each other. Growth stocks are correlated with growth stocks. Stocks in a similar industry are all correlated with each other. And so something like the NASDAQ, you'll see the NASDAQ stocks index has a much larger volatility than an index like the Dow Jones or the S&P 500, because the S&P 500 has a much more diversified holdings in terms of industry. And so let's assume that you've invested in an ETF. The assets are somewhat correlated, but their volatility is still at a level where you can accept, which is why most people invest in the S&P 500. And so does that mean you're safe? Well, not really. You still have to think about your goals and the assumptions that need to be true for those goals to be met. And so, for example, I guess anyone's goal with investing in the S&P 500 is that they want average market returns, and that in their mind, that is about 8 to 10% in the long run. And so what needs to be true in order for that to be true, in order for 8 to 10% to be true? Well, American businesses need to continue to do well. The American dollar needs to continue to be strong, which means it should continue to be the world reserve currency. And so anytime that the world reserve currency is threatened, we should expect the US government to take action against those actions, because otherwise they risk the valuations of their stock markets and their companies, which primarily do business in US dollars. Great. So the assumption is that the American economy will continue to do well over the long run, as well as the American dollar will continue to hold its value over the long run. Given those two assumptions, I can safely buy the S&P 500 index funds or ETFs, because if those two assumptions are true, then I will continue to get an average market return that I will be satisfied with. And so how do you test those assumptions? Well, you have to think about, well, what is America's place in the world, right? Okay, so right now, economically, they are number one, but then there's China, and China is making all these relationships with BRICS, and they're catching up. And so are they a threat to the American economy? The American leadership, right, with Donald Trump doing tariffs, how is that going to affect the stock market, if it is going to affect the stock market? Well, theoretically, tariffs increase domestic prices. And so the question you have to ask is, what are businesses likely to do? Okay, businesses are likely to pass those increase in prices in order to remain profitable to consumers. And so the next question you ask is, well, are consumers able to weather that storm? Right? And so if they are, then perhaps in the near future, we won't have a problem in the stock market. If they aren't, then perhaps in the near future, we should brace ourselves for a decrease in profitability of companies, which will reflect in the stock market. Great. And so, will America continue to have global dominance? That's really the first question, if you decide to hold an S&P 500 index fund. Now, there are other assumptions, like you probably believe that passive investing will beat active investing, which means that fees are pretty important to you. And so if you believe that active fund managers cannot beat passive fund managers in general, or that you are unable to find active fund managers that beat passive fund managers, which is probably a more reasonable claim, then it's probably a good idea to buy an S&P 500 index fund. So you have to think about all the assumptions that justify your financial decisions before you make the investment. And you can't be lazy with this stuff, because otherwise your decisions, your actions don't rest on sound arguments. And if the only assumption is the fact that your rich cousin was right about a stock last time, then you better check yourself. The third thing that you really want to do is you want to ask yourself the important questions and give yourself an objective answer. For the last 2 years, I had over $100,000, which was really over half of my invested assets at that time, invested in Alibaba. I bought in at just under $120. The stock eventually fell to $58 at its lowest point, but it now sits at $140 around there. My thesis at the time was that the stock was last at $120 at 2017, and that certainly the company has become more valuable in 6 years. I mean, this was 2022, near the end of 2022, so around 6 years. The thing that I neglected was, were there any changes in the business fundamentals? Will the company be affected by macroeconomic policies of other countries. And I totally neglected investor sentiment as a factor for stock price movements. And so in the short run, I was terribly down. And I also recognized that the price volatility when the stock was down affected my emotions, which probably either meant that I put too much money in the stock, or I needed to discipline my mind, or my decision actually didn't rest on sound claims, or all of the above. Regardless, the stock is now in the green for me and I'm making money with it. But my emotional side, interestingly enough, after all these years, still says to hold the stock until it doubles or triples. My objective side tells me that I should probably sell some, take some profits, and diversify, because that initial decision was a decision that I made without sound claims. And throughout the last 3 years, there's just been so many times and I kept logging on to Yahoo Finance to check the price and to check the news. And I would constantly be disappointed. I would look for news articles that would tell me about how the intrinsic value of the stock Alibaba was so much higher than what it was right now. And I looked for that confirmation, even though my objective mind knew that made no sense, that I wanted to not take responsibility for my actions, that I wanted some level of confirmation from some external stranger with qualifications I could not confirm to confirm my own beliefs, so I felt better about my decision. I don't ever want to put myself in that situation again, while knowing that perhaps it might still happen because I'm human. But just being more aware of that has made me a better rational thinker, which is what one needs when they are investing. And so 2 days ago, I sold some Alibaba to diversify, which obviously was the prudent thing to do, but was also difficult to do because I struggled for 3 days making that decision. And so you also need to develop an objective side and actually listen to your own advice, because chances are you have your best interests in mind, at least the objective you do. If you follow these 3 principles, then I hope you'll make some money in your investments, that you stop listening to your emotional side, and that you build a side of you that is prudent, that is objective, that is critical, and that is able to make decisions that are good for future you. With that in mind, I'll see you in the next video, and watch the rest of my videos to learn more about what I think about investing.